episode 2.
Silhouette, dark figure on it.
2 things to take care of. Want to hang this somewhere? It's gonna have to do for now because, this is a solo show. Solo. I guess solo's not so bad. There've been a lot of good solo acts. Maybe one day I'll have a co-host. Yeah, a co-host. And that'll do it for tonight's show. As always, stay lit. Man, wonder how I did. Thomas, that was great. How do you come up with these jokes? You, sir, are the best. That would technically make me a duo. And there have definitely been some cool duos out there. I think there's one more duo people forget about. Let's get on with the show. Today's topic, the topic right now, stocks and bonds. Due to the complexity of this subject, this will be a 2-part video because of the time required to explain what these two represent. So let's get started. When you buy the stock of a company, you own a piece of that company. Stocks represent ownership. When you buy the bond of a company, you lend that company money and they're going to pay you back principal and interest over a specified period of time. No ownership. Bonds represent debt. That's it. Man, really misjudged this one. 10 seconds? Guess we should try that again. Stocks and bonds! But first, a quick history lesson. If you take the time to look through history, you can see the beginning of some of today's modern marvels. Like before we got the Airbus A380, there were the Wright brothers. Before this smartphone, we had the Zach Morris phone. And before email, we had the fax machine. Well, we still got the fax machine. We need to go back in time and find the initial framework for stocks. And while we're at it, find the framework for the publicly traded companies that created them, the individuals that buy them, and the places that trade them. So let's go back. No, way back to ancient Rome. Information in a short history lesson with Thomas is brought to you by the great ancient historian Cicero. Cicero. Really? The first ever publicly traded company was the Publicani. In particular, Societas Publican not gonna work here anymore. Publicanorium. See, as Rome was turning into such a large empire, the Roman Republic did not have the infrastructure to carry out governmental tasks on its own. So the Republic contracted out services such as city street maintenance, temple construction, and tax collection to the Publicani. 2,000 years later, the trend continued. Publicly traded companies like these got started in their garage, So nobody wanted to start in their kitchen. Started in a garage, developed a product, filled out the articles of incorporation for their estate, and voila, a multi-billion-dollar corp with just a corporation to start. Today, if there's a company that interests you, like one of these, and you want to go along for the ride, then you can purchase a piece of that company. And that piece of the pie is called a stock. In Rome, individuals could buy a piece of the Societas Publicanorium, and that piece was called parte. If you did decide to buy, in ancient Rome, you were known as a participus, and today you'd be known as a shareholder. Now, you didn't just roll up to the emperor's doorstep or to your favorite company's headquarters and make your purchase. Nope, there are and were places where these were bought and sold. In ancient Rome, people gathered at the Forum. No, not that Forum. This Forum. The Forum near the Temple of Candor is where people gather to buy partes and other investments. Today, if you want to buy a stock, you use a brokerage firm. These brokerage firms are intermediaries between you and stock exchanges, where stocks, bonds, and other investments are bought and sold. And there we have it. The first publicly traded company, the earliest reference to stocks, the purchasers of those stocks, and the markets where they were traded. Not necessarily it. See, there's actually a debate about this one. The first publicly traded company. Well, maybe not a debate. More like a couple historians presenting evidence, but never arguing against one another. Probably because nobody cares. Let me explain. There's a scene in Pirates of the Caribbean where 2 of the characters are arguing about who they're at war with, and they show this. This is a symbol for the East India Company. Now, on the other side of the Caribbean is this company, the Dutch East India Trading Company. And this company is often identified as the first publicly traded company. The Dutch East India Trading Company, also known as the VOC, yeah, you know me, had one single mission. See, during the 16th century, the world was becoming more global and trade was huge. In particular, the spice trade. Portugal was dominating the spice trade at that time. And of course, with domination comes competition. So the Dutch government authorized the establishment of the VOC and let them set out to dominate the global spice trade. In order to finance this spice trade war, they needed cash. So they set up their own trading market in Amsterdam. This enabled the Dutch colonists to purchase fractional ownership in the VOC. And the money just started flowing in. Now the debate revolves around the corporate guidelines granted to both the VOC and the Societas Publicanorum. The VOC was organized as a joint stock company. See, at that time, most shipping merchants were organized as partnerships. And one of the biggest differences between the two is that in a partnership, when a partner died, the organization had to dissolve. But in the joint stock company, the company was technically a separate entity, which allowed it to continue in existence, which is more in line with today's corporate guidelines. Now, according to ancient historian Pomponius, of course, that is not much different than the guidelines granted to the Societas Publicanorum back in Rome, because they too are granted the ability to continue on in the event of the death of a partner. So feel free to jump to either side of the debate because I don't think it really matters. Coming up next on part 2. All I want to know is how I can get from here to there. Initial public offering. Invest in what you know. Buy low, sell high. It's common sense, right? Welcome back to the show.